Good afternoon, everyone. Thanks for joining us. My name is Denise Appleby, and Nicole Mayholtz is on the line with us today. Thank you, Nicole, for providing the opportunity to bring this very important topic to your audience. We're going to be talking about the recent IRS notice 2023-54, in which they addressed two topics: an extension of the waiver for excise tax on RMD failure, but only for a narrowly defined set of beneficiaries, and the rollover, the extension of the 60-day deadline for rolling over certain distributions. Both of these are RMD related. Now, what I'm going to ask you to do is, as we go along, if you have questions, please submit them using the Q&A feature. We didn't turn on the chat feature. That was not intentional. Next time we'll make sure it's on, because we want to give you more than one mode of communicating with us, or more than one avenue of communicating with us. So submit your questions. It doesn't have to be related to the topic that we're talking about today. If you have a question on Secure Act, as long as it's related to IRAs, and we can answer that. We don't do investments, as you know. So why are we here today? We want to talk about which beneficiary qualifies for the waiver of the RMD tax for 2021, 2022, and yes, 2023 was just added. And what happens if your client takes an RMD that I'm calling a non-RMD, because it would have been an RMD up until December 29th, when Secure Act 2.0 was signed into law. And you might have noticed the Band-Aid on the original screen. That was intentional, because it's just another Band-Aid provided by the IRS to some of the things that we may or may not agree that they should really put a permanent solution to. And we're going to be looking at alternate solutions to rollovers beyond those provided on the notice 2023-54. This is a little bit about me. I won't waste your time by having you look at it. And general disclaimer on copyright, I think you appreciate it if we say everything we talk about here today is just for educational purposes only. None of it can be used for any type of advice whatsoever. Now, if we're going to be talking about RMDs, we have to look at what brought us here today. And that is some of the key changes that have been made in recent years, the first of which is Secure Act 1.0. But for purposes of today's presentation, we're going to be focusing on only those changes that affects what we're going to be talking about, because you and I know that Secure Act 1.0 made a lot of changes, right? So did Secure Act 2.0. Now, Secure Act 1.0 was signed into law on December 20th, 2019. Yeah, they gave us only a week to get ready. And some of the key changes were it increased the RMD starting age to 72, and it introduced us to eligible designated beneficiaries and made it so that eligible designated beneficiaries are now the only class of beneficiaries that can take distributions over their full life expectancy. Notice I say full and emphasize that, because designated beneficiaries in some cases use the life expectancy method to calculate RMDs, which is one of the reasons why we're here today, but not over their full life expectancy, because they can't go beyond 10 years. One of the changes that were made on the Secure Act 1.0. Another one of the change that was made on the Secure Act 1.0 is that they introduced the 10-year maximum limit for successor beneficiaries. Now, when Secure Act 1.0 was signed into law, I know you heard the bells ringing about the stretch is dead, the stretch is dead. And this is what we were talking about, because before Secure Act 1.0, if you named a beneficiary that had a life expectancy of, say, 50 years, then even if you count successor beneficiaries, that IRA could stretch over that 50-year period. But on the Secure Act 1.0, there is a maximum period of 10 years over which any successor beneficiary can stretch distributions. Now, One of part of what we need to know here today when we're talking about these changes is the different classes of beneficiary. And the reason for that is the RMD waiver only applies to designated beneficiaries. And so the question becomes, well, what is the difference? We know that a beneficiary is any party that inherits a retirement account, but now we have different classes of beneficiary. A designated beneficiary who's an individual or a qualified see-through trust. We have the new eligible designated beneficiary, which includes which are the surviving spouse of the IRA owner, a child of the IRA owner who has not reached the age of 21, a beneficiary who's disabled or chronically ill, or a beneficiary who doesn't fall under any of the above, but is not more than 10 years younger than the IRA owner. And one of the things we need to remember here is that when they say not more than 10 years younger, that includes older too. So now sometimes it's beneficial to name a beneficiary that's older than the retirement account owner, if the objective is to allow a stretch for as long as possible. And this status is determined at the time of death, which means, for instance, if someone inherits an IRA today, and they're not a designated beneficiary, but they become disabled tomorrow, they're still not an eligible designated beneficiary. And that's what I should have said. That's what I said. So the eligible designated beneficiary status is determined at the time of death. Anything that happens afterwards doesn't change that. We have non-designated beneficiaries or non-persons, and we have successor beneficiaries. The successor beneficiary is the person that inherited the account from the original account owner. For the RMD waiver, we're going to be paying attention to designated beneficiaries and successor beneficiaries because they are the ones who were covered. Now, proposed RMD regulations were published on February 24th. Here's why this is important. When Secure Act 1.0 was signed into law, the language was very clear. I'll say it until the cows come home, because the language said, if you are a designated beneficiary, you are subject to the 10-year rule. The 10-year rule works like the old 5-year rule, where distributions are optional until the end of year 5. Right? And this new 10-year rule applies regardless of the age at which the IRA owner dies. Then the proposed regulations came in and they said, no. What you're forgetting is that there is a at least as rapidly rule, which still applies. And what the at least as rapidly rule means is once the IRA owner has already started taking RMDs, you cannot stop that trickle. So any beneficiary that inherits an account from someone who died on or after the required beginning date must continue to take RMDs. The question is, how fast should they continue taking the RMDs? And that is determined by the beneficiary profile. Are they an eligible designated beneficiary, a non-designated beneficiary, etc.? But this is what creates the problem, because we have been telling designated beneficiaries that if you inherit an IRA, you don't have to do anything until the end of year 10. When the proposed regulations were published on February 24, 2022, then we had to pivot and reach out to those clients and say, listen, if you inherited an IRA from someone who died on or after the required beginning date, you were actually required to take annual RMDs. So you can imagine how upset everyone was. And they let the IRS know in the comment during the current comment period for the proposed regulations. And the IRS acknowledged that the language could have been clearer. And in response to that, they published Notice 2022-53 last year. And they said, listen, here's what we're going to do. We agree that the language could have been clearer. So what we're going to do is for any designated beneficiary who inherited an IRA from someone who died on or after the required beginning date, we're going to waive the excise tax for 2021 and 2022. And if they already paid the excise tax, all they have to do is ask for a refund, and we will honor that request. One of the questions I get often is, well, who really benefits from this? Because, you know, part of what we are hearing is that it applies to every beneficiary. No, it doesn't. It only applies to two classes of beneficiary: a designated beneficiary, who is not an eligible designated beneficiary, who inherited an IRA from someone who died on or after the required beginning date. Now, these designated beneficiaries are subject to the 10-year rule, which means that the account has to be fully distributed by the end of the 10-year period. In addition to that, they have to take annual RMDs over their life expectancy using the single life expectancy table, starting by December 31st of the year following the year in which the IRA owner died. Now, I made sure to include not applicable to Roth IRAs here, and that's because Roth IRA owners are not subject to RMD, so there's no required beginning date. This does not apply to Roth IRAs at all. The second class of beneficiary it applies to is a successor beneficiary of an eligible designated beneficiary who was taking life expectancy distributions. So assume that a eligible designated beneficiary inherited an IRA in 2020. They were eligible to take distributions over their life expectancy, regardless of the age at which the IRA owner died, right? If the IRA owner died before their required beginning date, then they could choose between the 10-year rule or the life expectancy rule. If the beneficiary, if the eligible designated beneficiary chose the life expectancy rule, if the account owner died before the required beginning date, or if the account owner died on or after the required beginning date where the life expectancy is the only option, then they would have been taking distributions over their life expectancy. If such an eligible designated beneficiary dies, then the successor beneficiary must now continue taking those distributions using the life expectancy method that was being used by the primary eligible designated beneficiary. But the successor beneficiary must now fully distribute the account by the end of the 10th year following the year in which the eligible designated beneficiary dies. Now, here's a little twist. We know what an eligible designated beneficiary is, right? But there is one addition to that that is often missed. If a regular designated beneficiary inherited an IRA before 2020 and they were taking distributions over their life expectancy and they die after 2019, then they are classified as an eligible designated beneficiary. And you know, right now your mind's working saying, oh my gosh, I need a checklist. And you know, we're very big on checklists, and that is true. So my recommendation is to use this information to help beef up your checklist so that when you're having conversations with your clients about RMDs in general, distribution options in general, and in particular for today, whether they qualify for the waiver of the excise tax under these notice. Someone is asking, can we please receive copies of the slides? Thanks. Barbara, we love to share. We're very generous over here. So absolutely, we'll send out a copy of the slides to you. Now, I just talked about Notice 2022-53, in which the IRS waived the excise tax for designated beneficiaries who inherited retirement accounts from someone who died on or after the required beginning date. Now, all Notice 2023-54 did for those beneficiaries was to extend it for one more year. So now a designated beneficiary who inherited an account from someone who died on or after the required beginning date gets a waiver of the excise tax for 2021, 2022, and 2023. One of the questions I get a lot is, well, will they have to file Form 5329 to claim a waiver of the excise tax? And the answer is no, because this waiver is automatic. So good news there. Here's something that we need to bear in mind. Only the excise tax is waived RMDs are not waived. Now, if we're talking about IRAs, it really doesn't matter because, for instance, if someone inherited an IRA in 2020, we know the account has to be fully distributed by the end of 2030 if they're a designated beneficiary. We know now that they get a waiver for 2021, 2022, and 2023. That only means that the excise tax is waived. They still have to fully distribute the account by the end of 2030. So for IRAs, this is really a non-issue, me saying RMDs are not waived. But when it comes to employer-sponsored retirement plans, we got to be careful. Why is that? Because RMDs are not eligible to be rolled over. And we know that designated beneficiaries are eligible to roll over amounts from their, say, inherited 401k accounts to a inherited or beneficiary IRA. If you have a client who inherited a 401k in 2020, 2021, or 2022, and you're having conversations about them doing a rollover of those accounts to a beneficiary IRA, check to make sure that no RMDs are not included. And this could mean RMDs for 2021, 2022, and 2023. This is why I put that Band-Aid in the beginning here, because in 2020, when the IRS waived RMDs because of COVID-19 under the CARES Act, they said straight up, no RMDs, don't take any distribution unless you want to. Now, all they're telling us here is that the excise tax is waived. So they didn't take it far enough, and they really should. The 10-year rule still applies. If your client doesn't take the RMD in those 3 years, they still have to empty the account by the end of year 10. And so the question for the client's tax advisor is, should my client really take advantage of this? Because if they do, assuming that they inherited the account in 2020, if they don't take any RMD for 2021, 2022, 2023, then they have 7 years over which to distribute the balance. And part of what the accountant's going to look at is, well, look, let's see if there's any tax benefit or other type of benefit for this client to not take the RMDs in 2021, 2022, or 2023. Maybe they're receiving some sort of a state benefit. Could it affect Medicare benefits? I'm not an expert in that area, but I'm giving you examples. Let's say too, this beneficiary is planning to retire the next year. When they retire next year, they are not going to have their usual compensation to be included in income. So maybe for them, it makes sense to push those off until next year. So there are a lot of scenarios here that we need to think about before we advise clients on which option they should choose. Another question that I get is, well, would they have to play catch up and take the 2021, 2022, and or 2023 RMDs in 2024? The answer is no. There's no catch up required. So all we have to do is decide how much they need to take in 2024. And as long as the amount they take is no less than the RMD, then everything's copacetic. Secure Act 2.0 signed into law on December 29, 2022. Don't ask me why they do this to us, right? Signed this into law on December 29, 2022, which means that you, me, IRA custodians, everybody have to get ready to roll out some of these changes on January 1st. What's that, like 2 days later? Come on, that's not practical. And so one of the problems that came out of that is the Secure Act 2.0, they reduced the excise tax and RMD failures. Thank you. 50% was just ridiculous. So now it's 25. And if it's corrected during a correction period, it's only 10%. They also increased the RMD ages. Thank you again. But come on, last day of the year, pretty much. And so when a client asks you now, when am I supposed to start taking my RMDs? Once upon a time, we used to say 70 and a half. Once upon a time, we used to say 72. Now we're going to say, hang on a second. What's your date of birth? because depending on what your date of birth is, that's going to determine what when you start taking your RMDs, right? So you can see here for someone who was born June 30th, 1949 and earlier, their first RMD age is age 70 and a half. Those who were born July 1st, 1949 to December 31st, 1950, it's age 72. And those who were born January 1st, 1951 to December 31st, 1959, it's age 73. Now look at this. Those who were born January 1st, 1959 and after, it's going to be age 75. What's wrong with this picture? 1949 falls into two categories. That's not my mistake. That's exactly how it was written in Secure Act 2.0. The IRS has been made aware of this, and we expect them to issue technical corrections soon. And as soon as they do, we'll make sure that you are notified. Now, we're going to give you a copy of my RMD quick reference guide. So you don't have to remember all of this. You just need to know where to find the quick reference guide so you can pull it up or download it and see what the starting age is for required minimum distributions. You still got to remember the required beginning date. The required beginning date is April 1 of the year that follows the year in which the individual reaches the applicable RMD age. That's what we're saying now. Applicable RMD age. We're not saying 70 and a half or 72, right? And so the required beginning date is April 1 of the year that follows the year in which the individual reaches their applicable RMD age. If they're in an employer plan and the plan permits, the age can be deferred past the ages that we just looked at in that table until the year of retirement. But we have to know the required beginning date. Why? Because when you're having that conversation with the beneficiary, two of the first questions you're going to ask is, what is the date of birth of the IRA owner? What is the date of death of the IRA owner? Why are you asking these questions? Because you need to determine if the IRA owner died before the required beginning date or not. Because as we have established, this is what's going to drive the distribution options for the beneficiary, right? Please keep the questions coming in. So here's one of the fallout from Secure Act 2.0 being signed into law on December 29th, 2022. An individual who reaches age 72 in 2023 benefits from the increased age, which means they don't have an RMD for 2023. Pretty cool, right? But here's the problem. Plan administrators and IRA custodians didn't get to change their systems in time for this change. And so plan administrators who automatically send out RMDs just sent them out for these individuals, even though they weren't supposed to take RMDs. So now you have clients with a 401k who got this check in their hand and a letter saying, this is your RMD for 2023. And that client reached age 72 in 2023. Here's another issue. IRA custodians are required to send out an RMD notice to any IRA owner who must take an RMD for the year, as long as the IRA custodian held the account as of December 31st of the previous year. Now, some of these custodians didn't get to stop those notices from going out. And so a lot of clients who got those letters, for those who like to just get things done instead of waiting until the last minute, they took those distributions. Only now we're realizing that these distributions are not RMDs at all. What they should have done was to chuck them in the garbage, but then they didn't have you to tell them that, right? And so many of them took those distributions in response to those letters. So here's the transition relief that the IRS provided. Any distribution made from a plan or IRA from January 1st, 2023 to July 31st, 2023, made to someone who was born in 1951, meaning that they reach age 72 in 2023, they will have until September 30th, 2023 to roll over that distribution. Now, remember, the rollover deadline is usually 60 days, right? This is one of the waivers on the notice 2023-54. So if you need to get out the message to your clients, this is one of the things that you want to remind them of. Looking at this example here, John was born in 1951. He received a distribution of $20,000, which was treated as ineligible to be rolled over because it was mischaracterized as an RMD. John has until September 30th, 2023 to roll over that distribution. Now, IRAs comes with a little twist. Of course they do. We know that when you take a distribution from an IRA and roll it over to another IRA, you can only do that once during a 12-month period, right? Now, looking back to 2020, the IRS waived this 1-year limitation. In this case, they're saying, if you have already done an IRA to IRA rollover in the preceding 12 months, we're not going to count that. You can still roll over this RMD. But if you roll over this RMD looking forward, you cannot do another IRA to IRA rollover in the coming 12 months. But here's a tip. The IRS has a procedure. The most recent publication is Notice 2020-46. We'll send you a copy as part of your handout. And in this, the IRS says, if you miss your 60-day deadline, because of reasons beyond your control, including the financial institution making a mistake, then we'll waive the 60-day deadline. And in general, you have 30 days to put it back, starting with the date for which the reason for missing the deadline no longer exists. Now, what if your client is going to break the 1 per year rollover rule? The solution here is to roll over the amount to an employer plan. That would be a non-taxable distribution, but we first have to wonder or ask, does the plan accept rollovers or not? And does the client even have access to an employer plan? If that's not a solution, then the next solution is to roll it over to a Roth IRA. And right now you're saying, but Denise, a Roth conversion is taxable. That's not what we want. But if your client's up against the fence and that's the only solution, then you got to ask yourself, which is better? Keep it, pay taxes on it, pay taxes on any earnings as they are earned, or put it in a Roth, pay taxes on it, and the earnings grow tax deferred and eventually become tax-free when the client's eligible for a qualified distribution. I think we will agree that the Roth conversion is the better option. Please submit your questions. We wanted to do this in half an hour. We'll come back to these slides. But let me give you some practice pointers in the meantime. I see some questions coming in on emails too. You can use this chat feature to ask your questions, but we welcome questions in any form of medium. So here's a tip. I've spoken to some of the larger custodians, and I know they can run a report for you to identify IRA owners who reach age 72 in 2023. Reach out to those clients, check to see if they took distributions in 2023, and if they did, send them a note that says, listen, this distribution was optional. If you didn't want to take it, you can still put it back by that September deadline, right? And that would help. That will ensure that it's excluded from income. Part of what we like to do here is to create letters to send to clients. For something like this, you want to create a letter that includes both provisions, but send a follow-up letter to clients for each provision, because sometimes a client gets a letter, it's just too much, they feel overwhelmed. If you can break it down in bite-sized pieces, then sometimes it's easier to digest for the clients. Short and spicy, right? Please submit your questions. While you're doing that, we wanted to let you know that we have sessions that we're going to be presenting in the near future. If you have ideas for topics, we welcome those. We want to give you cover topics that you ask the key questions on, or the most questions on. And just a reminder that Brentmark software will help you calculate your RMDs and figure out Roth conversion suitability. And at IRApublications.com for today, if you purchase this quick reference guide, the PDF version, and you use discount code Brentmark, you get a $50 discount. So you get that booklet for under $100. Here's a question. How does an eligible designated beneficiary choose the 10-year rule? Does it happen automatically by not taking RMDs? Does the EDB elect the 10-year rule somewhere on the tax return? It's definitely not on the tax return. The plan document, usually a qualified plan document, will have a procedure in place. In some cases, it defaults to the 10-year rule instead of the life expectancy rule, or they may require the beneficiary to make an election by December 31st of the year following the year of death. And I'm so glad you asked that important question, because if you are working with an eligible designated beneficiary who inherited a 401k account, for instance, and the plan defaults to the 10-year rule, but your client wants to use the life expectancy rule, then you help your client perform a direct rollover of those assets to a beneficiary IRA that allows them to take distributions over their life expectancy. That has to be done by December 31st of the year following the year of death. Can any distribution made in 2023 to a person born in 1951 receive the extension to the 60-day rule up until September 30th, or just amounts mischaracterized as RMD? I read the notice to read the latter, and you read your understanding of the notice is correct. This automatic extension only applies to amounts mischaracterized as RMDs. But remember that there are other options if your client misses a 60-day deadline. There are limited qualifications for that, so we can't just say that to everyone. But if someone was ill, or if someone was in prison, things like that, if the financial institution made a mistake, then they might qualify for a waiver of the 60-day deadline. How do we sign up for the next session? This is great. Thank you. We're going to be sending out communication about how you can sign up. And if you have questions about the topics that we need to cover, please let me know. Is it true that the IRS will not waive the excise tax for RMDs anymore? I've heard that rumor, and it's not true. And here's what I've heard. Because under Secure Act 2.0, the excise tax can be reduced to as low as 10%. Some people are saying that the IRS will not be waiving the excise tax anymore. But when you look at what survives of the tax code after Secure Act 2.0, it still says the IRS will waive the excise if the deadline was missed due to reasonable error. 10% can be a lot. 10% sounds like nothing, but imagine 10% of $20,000 or $50,000. So apply for the waiver for your client. Have the IRS tell you no. We don't say no unless they tell us no. And in my experience, the only time the IRS has said no is if the form was filled out incorrectly, and that's an easy fix. What are the distribution options for a Roth IRA? It depends on who the beneficiary is, the class of beneficiary. Whatever rules that apply to an IRA owner who died, a traditional IRA owner who died before the required beginning date, applies to a Roth IRA regardless of the age of the Roth IRA owner. So whether someone dies at age 10 or at age 90, the distribution options are the same for the beneficiary. The only distinction is, are they an eligible designated beneficiary, plain designated beneficiary or a non-designated beneficiary. How would the beneficiary roll over the 401k to the IRA? Excellent question. The first thing you want to do is make sure that the IRA that you set up on the receiving end is a beneficiary IRA or inherited IRA, whatever name they want to use. Make sure it's not the individual's own IRA. And then you contact the plan administrator, fill out the paperwork, whether it's online or hard copy paperwork. And this is very important. The instructions have to say to process the amount as a direct rollover to the beneficiary IRA. And the reason for that is if the distribution is paid to the beneficiary, those cannot be rolled over. So instead of them getting 10 years, they now have to include the amount in income for 1 year. So we got to be very careful about that. Can a spouse beneficiary roll over a 401k? Yes, they can. But with a spouse beneficiary, you want to be careful. Is the spouse beneficiary under age 59 and a half? And I'm asking that because the spouse beneficiary can roll it to their own IRA. They can also roll it to a beneficiary IRA. One of the courses that we're going to be covering is the special options that are available to spouse beneficiaries. And we'll be talking about some of the tricks and traps and solutions that you can implement for your spouse beneficiary client. I do not see any more questions, but from Nicole May Holst and I, thank you very much for joining us, and we look forward to having you on our future sessions. Thank you.